This stock beat the S&P 500 by 300% in 1 year. If you bought it, you would be rich. This stock lost 95% in the same year. If you bought it, you would be broke. Here is what most people hear and think sounds like decent odds. 31% of individual stocks beat the S&P 500 in any given year. Roughly 1 in 3. But here is what most people do not hear. You cannot predict which ones. You might pick the one that beats. Or you might pick the two that lose. But before you even consider stock picking, you need to hear the Bessembinder bomb. Professor Hendrik Bessembinder at Arizona State University published his landmark 100-year update in March 2026. He studied 29,754 U.S. stocks over the full century, from 1926 through 2025. The median stock return, negative 6.9%. Negative, the typical stock in 100 years of American market history lost money. 57 to 60% of all stocks that ever listed failed to beat even Treasury Bills, not the S&P 500, not the index, Treasury Bills. The supposedly safe, boring cash equivalent that pays 3 to 4%. More than half of all stocks in a century of U.S. market history could not even beat cash. The 4% revelation. Only 4% of stocks, approximately 1,100 out of 29,754, accounted for all $91 trillion in net wealth creation over the century. The other 96% collectively matched Treasury Bills. 46 firms account for half of that $91 trillion. Apple, Microsoft, Amazon, Nvidia, Exxon, and a handful of others, down from 89 firms in the 2018 version of the study. The concentration is increasing. The haystack is getting bigger. The number of needles is getting fewer. And here is the statistic that should end the stock picking debate forever. If you pick just 10 stocks for your portfolio, there is approximately a 66% chance you hold 0 of the top 4% that created all the wealth. In this video, the Bessembinder 100-year dataset that proves the typical stock loses money. SPIVA 2025 data showing 79% of professional fund managers failed to beat the S&P 500 and 93% failed over 20 years. The asymmetric payoff structure explaining why losses are more likely than gains. The 66% probability problem proving you will probably miss every mega winner. Why the selection problem is mathematically unsolvable. The behavioral traps of survivorship bias and confirmation bias that make you think you are skilled when you are lucky. Why index funds win on probability even though they have lower maximum returns, when individual stocks might make sense, which is rarely. And the verdict, own the entire haystack, because you cannot identify the needles in advance. Welcome back to Faceless Millionaire. The most common mistake in personal finance is chasing individual stock returns while ignoring probability. Yes, some stocks beat the index, but you cannot predict which ones, and the data from the last 100 years proves it. Subscribe and let us walk through the most important investment research most people have never heard of. Quick disclaimer: I am not a financial advisor. The statistics cited are from peer-reviewed academic research by Bessembinder and the SPIVA scorecards published by S&P Dow Jones Indices. Past performance does not guarantee future results. Individual stock returns are highly volatile and can result in total loss. Consult a fiduciary financial advisor before investing. The study. Professor Hendrik Bessembinder at Arizona State University. Paper title: 100 Years in the U.S. Stock Markets, published March 2026 on SPIVA. Dataset: 29,754 common stocks listed on U.S. public stock markets from 1926 through 2025. This is the most comprehensive study of individual stock performance ever conducted. The original version was published in the Journal of Financial Economics in 2018 and covered data through 2016. This update adds 9 additional years of data and the conclusions are even more striking than the original. Finding 1. The median. The mean buy and hold return across all 29,754 stocks is over 30,000%. Sounds incredible, but the median buy and hold return is negative 6.9%. The middle stock in 100 years of U.S. stock market history lost money. Why the massive gap between mean and median? Positive skew. A tiny number of mega winners pull the mean far above what most stocks actually deliver. Altria, formerly Philip Morris, returned 266 million% over its lifetime. Apple returned thousands of percent. These extreme outliers haul the average upward. But a stock can rise by thousands of percent while it can only fall by 100%. This mathematical asymmetry creates the illusion that stocks on average are good investments. They are not. A few stocks are extraordinary. Most are mediocre to terrible. And the median, which represents the typical investor's experience when picking a single stock, is negative. Finding 2. The 57%. 57 to 60% of all stocks reduce shareholder wealth over their full lifetimes in the public market. They failed to beat even Treasury Bills, which are the safest, most boring investment in existence, paying roughly the cash rate. Not the S&P 500 index. Not corporate bonds. Treasury Bills. Cash equivalents. More than half of every company that ever went public in the United States of America, over 100 years, destroyed value relative to simply putting your money in a savings account. The stock market as a whole beats T-bills dramatically over time. But the majority of individual stocks within that market do not. The market's aggregate gains come entirely from a tiny minority of mega winners pulling the average upward while the majority drag it down. Finding 3. The 4%. Only 4% of stocks, approximately 1,100 out of 29,754, accounted for all $91 trillion in net shareholder wealth creation since 1926. The remaining 96% collectively matched Treasury Bills. Read that again, 96% of all stocks in 100 years of U.S. market history collectively produced zero net wealth above what you could have earned in cash. All the wealth, every single dollar of the 91 trillion, came from just 1,100 companies. And the concentration is getting worse. In the 2018 version of this study, 89 firms accounted for half of the total wealth creation. In the 2026 update, just 46 firms account for half of 91 trillion. Down from 89 to 46. The haystack grew larger, but the needles got fewer and more concentrated. Finding 4. The 66% problem. If you build a portfolio of 10 stocks, which is approximately what most individual stock-picking investors hold, there is a 66% chance you hold 0 of the top 4% that created all the wealth. 2/3 probability of completely missing every single mega winner. With 20 stocks, still a 44% chance of 0 mega winners. With 50 stocks, 13% chance. With 500 stocks like VU, 0% chance of missing them because you own all of them. Every single one of the 4% that created all 91 trillion in wealth is in your portfolio. This is why index funds win. Not because index investors are smarter, not because passive investing is sophisticated, because buying the entire market guarantees you own the winners without having to identify them in advance. SPIVA Year-End 2025, published by S&P Dow Jones Indices in March 2026. 79% of active large-cap U.S. equity fund managers underperformed the S&P 500 in 2025. This was the 4th worst year for active managers in the scorecard's 25-year history. Over 3 years, 67% underperformed. Over 5 years, 89%. Over 15 years, 0 out of 22 U.S. equity fund categories had a majority of managers outperforming their benchmarks. 0 out of 22. Over 20 years, 93% underperformed. These are professional managers with Bloomberg terminals costing $20,000 per year, Teams of PhDs analyzing every data point, billions in research capital, real-time market access, and decades of experience. They still lost. Consistently, persistently, overwhelmingly, the persistence problem. The SPIVA Persistence Scorecard for 2025 shows that among funds ranked in the top half of performance in 2021, almost none remained in the top half for all 4 subsequent years through 2025. Outperformance is not persistent. It does not repeat year over year. A manager who beats the index this year is statistically no more likely to beat it next year than a randomly selected manager. This is the hallmark of luck, not skill. If outperformance were driven by genuine skill, it would persist over time the way athletic skill or musical skill persists. It does not. Luck perfectly explains the 21 to 31% that beat the benchmark in any given year. Skill explains almost none of it. The implication for you, personally. If professionals with every conceivable advantage, including capital, data, teams of analysts, decades of experience, and algorithmic trading systems, beat the index only 7 to 21% of the time over 20 years. What are your odds? You have free financial news that arrives with a 24-hour delay compared to professional terminals. Public earnings reports available to everyone simultaneously. 5 to 10 hours per week to research compared to their 50+. 10 to 100,000 to invest compared to their billions. No Bloomberg terminal. No PhD research team. No inside access to company management. Your informational advantage over professionals? 0. In fact, your informational disadvantage is roughly 1,000 to 1. Your realistic odds of consistently beating the index over 20 years? Approximately 0. The asymmetric payoff structure. A stock can lose 100% of its value through bankruptcy, fraud, or obsolescence. Total loss. A stock can theoretically gain unlimited amounts, thousands of percent or more. But the probability is reversed from what you want. Losses are common. Major gains are extremely rare. Thousands of companies go bankrupt every year across the U.S. market. Companies that achieve 100 times returns, maybe 10 per year out of thousands. Bessembinder found that the average company remained publicly listed for only 11.6 years before disappearing through acquisition, bankruptcy, or delisting. Most individual stocks do not survive long enough for compounding to work. The gravitational pull of the stock market is downward for individual stocks. The upward pull that makes the overall market positive comes entirely from the tiny 4% of mega winners hauling the average upward. The selection problem. You now know that only 4% of stocks create all the wealth. The question is, can you identify that 4% in advance? If the answer is yes, you have solved the central problem of all financial economics. You should be managing a $1 trillion hedge fund. Every institution in the world would pay you unlimited fees for that ability. If the answer is no, which it is, you are gambling when you pick individual stocks. The evidence says no unambiguously. Bessembinder shows that concentration is increasing, with fewer firms creating more of the wealth over time. The winning firms change across decades. The dominant companies of the 1960s are not the dominant companies of the 2020s. Past winners do not reliably predict future winners, as the SPIVA persistence data demonstrates conclusively. No signal, no fundamental analysis, no technical indicator, no machine learning model has been shown to reliably identify the 4% before they win. The selection problem is unsolvable by any currently known method. The behavioral traps. Survivorship bias. You pick 5 stocks. 1 wins by 300%, 4 lose by 30% each. You remember the winner vividly. You forget the 4 losers almost immediately. You tell your friends about the winner. You construct a narrative of skill. Reality, you got lucky on 1, made bad picks on 4, and net underperformed the index. Confirmation bias, you create a story explaining why the winning stock succeeded. I analyzed the management team. I saw the AI trend early. You use that same reasoning to pick your next stock. The next stock also loses. You create a new story explaining why it failed despite your sound reasoning. The cycle repeats indefinitely, reinforcing your belief in a skill that does not exist. Anchoring. You bought a stock at $50. It drops to $30. You refuse to sell because 50 is your mental anchor. You will sell when it gets back to 50, you tell yourself. The stock drops to 5. You lost 90% because of a mental anchor that has zero connection to the stock's actual value. Why index funds win? An index fund like VU holding 500 stocks means you own all 4% of the mega winners automatically. No selection is needed. No prediction is needed. No research team. No Bloomberg terminal. Bessembinder himself wrote in his paper, "These results should be of interest to any long-term investor assessing the relative merits of broad diversification versus narrow portfolio selection." The data is the argument for indexing, not against it. By owning all 500 stocks in the S&P 500, you guarantee that every single mega winner is in your portfolio. Yes, every single loser is also in your portfolio. But the winners more than compensate for the losers. That mathematical reality is exactly how the S&P 500 has averaged 10% per year over 7 decades. The probability comparison. S&P 500 index, 88% of calendar years are positive with an average return of approximately 10%. Individual stock, only 43% beat even Treasury Bills over their lifetime, according to Bessembinder. Median lifetime return negative 6.9%. The probability of a positive outcome over 20 years. With the index, 99.9% historically. With an individual stock, approximately 40%. Over 40 years, the index has been positive 100% of the time in every historical 40-year period. Individual stocks, significantly below 50%, with the majority producing wealth destruction. You sacrifice maximum potential return of 1,000% or more for dramatically higher probability of a positive outcome. In investing, probability beats maximum potential outcome every time over long horizons. The compounding advantage. 10,000 in VU at 10% for 40 years, 452, 592. 10,000 in the median individual stock at negative 6.9% for the average listing period of 11.6 years according to Bessembinder, approximately 4,800. You lost $5,200. Then what? The company is delisted. Your money is gone or severely diminished. You need to pick another stock. And then another one. For 40 years. Each time you pick, 57% chance that the new stock also fails to beat cash. The index fund approach. Buy VU once, hold for 40 years, completely automatic. No decisions to make. No repicking required. No risk of holding a stock that gets delisted. VU replaces failing companies automatically because the S&P 500 committee adds new winners and removes declining companies on a regular schedule. This is the ultimate structural advantage of index funds. The index self-heals. Bad companies leave. Good companies enter. You get the benefit of constant portfolio renewal without making a single decision. The math that ends the debate. Bessembinder, 4% of stocks account for all wealth creation. 96% collectively match Treasury Bills. SPIVA, 79% of professional managers underperformed in 2025. 93% over 20 years. Probability, 66% chance that a 10-stock portfolio misses all mega winners. 0% chance that an index fund misses them. Compounding, the index at 10% for 40 years turns 10,000 into 452,000. The median individual stock at negative 6.9% destroys your capital. Persistence, outperformance does not repeat from year to year, confirming it is luck rather than skill. The conclusion, the only guaranteed way to own the 4% of stocks that create all the wealth is to own the entire market. That means an index fund, VU or VT. Everything else is gambling dressed up as analysis. When individual stocks make sense, which is rarely. Scenario 1. You have genuine industry knowledge and the information is not yet reflected in the stock price, and acting on it is not insider trading. Even then, transaction fees and tax drag from trading usually erase whatever informational edge you had. Scenario 2. You can afford to lose 100% of the position. Allocate a maximum of 5 to 10% of your total portfolio to individual stock picks. The remaining 90% stays in index funds. This caps your underperformance while satisfying the urge to participate. Scenario 3. You genuinely enjoy researching and picking stocks as a hobby, and you accept the cost. The cost is approximately 2 to 3% annual underperformance versus a pure index approach. Over 20 years on $100,000, that hobby costs $50,000 to $80,000 in foregone wealth. If you enjoy the process and can afford the price, that is your decision to make. For 95% of people, 100% index funds is the mathematically optimal allocation. Period, no exceptions. The honest recommendation. 95% of your portfolio, VU or VT, an index fund charging 0.03% in fees. You own the entire U.S. stock market, and you guarantee that you own every single one of the 4% of mega winners that create all the wealth. 0 to 5% optional, individual stocks as a hobby. Accept the cost of underperformance. Limit the potential damage. Never 100% individual stocks as a serious wealth-building strategy. The data from 100 years of U.S. stock market history is unambiguous. Bessembinder studied 29,754 stocks. The median stock lost money. 57% failed to beat cash. Only 4% created all the wealth. You cannot identify that 4% in advance. Professional managers with every advantage cannot identify them either, as 93% fail over 20 years. The only winning move is to own everything. Own the haystack. Stop trying to find the needles. The final verdict. The 31% headline is true. Some individual stocks do beat the index every single year. But Bessembinder's 100-year study shows the deeper truth. The median stock return is negative 6.9%. 57% of all stocks fail to beat even cash. Only 4% create all $91 trillion in wealth. 46 firms account for half of it. Picking 10 stocks gives you a 66% chance of holding 0 mega winners. SPIVA confirms professional managers fail 79% of the time in a single year and 93% over 20 years. The 31% statistic actually proves the case against stock picking, not for it. Because you cannot predict which 31% will beat this year. You will probably hold the 69% that lose. And the 4% that create all the wealth will be sitting inside your index fund automatically, working for you, compounding for you, without you having to identify a single one of them in advance. Own VU. Own the market. Own the 4%. Stop trying to be the statistical exception. The math spanning 100 years and 29,000 stocks says you are not. 29,000 stocks. 100 years. 4% created all the wealth. You cannot pick them, but you can own them all. VU. One fund. Every mega winner included. Drop a stock ticker in the comments and I will look up its Bessembinder lifetime return for you. Hit subscribe. See you tomorrow.